compliance, communication, and financial fluency. Our speakers today are Jerry Shafran and Richard Balland. At this time, all lines have been placed on mute to prevent any background noise. We will have a Q&A period at the end of the presentation. Type your question using the pane at the right of your screen. Please identify the name of your organization at the beginning of your entry. Today's materials are available by clicking on the small orange arrow at the top of your screen to expand the menu. This webinar is being recorded and will be available on the CIHQ ARS Partner Webinar page within a couple of business days. It's now my pleasure to turn the conference over to our speaker, Jerry Shafran. Jerry, you have the floor.
Thank you, Michelle. And I want to start off by thanking the CIHQ organization for the opportunity today to spend a little time with its members around the concept of financial fluency. With us is Richard Balland. Richard has a wealth of experience as an interim CFO with many different hospitals throughout the country. Richard brings just years and years, sorry Richard, years and years of financial background as a CFO. I think once we went through this presentation and we were practicing, the amount of information that Richard has as it relates to this topic is it's overwhelming. I'm really excited that we have this opportunity to bring this second webinar to you. This is the second in a three-series webinar, or three series of webinars we're doing with CIHQ. All of these webinars are focused on making more effective, better business people out of folks that work within healthcare. So let's just spend a minute or two to talk about why this is important. I'm a vendor. I come at the compliance and quality and the healthcare function candidly as a salesman. But one of the things that I feel confident in stating, even though I'm not part of your industry, is that the concept of business in healthcare and how the business of healthcare gets done is something that can be challenging to learn and understand. And at the end of the day, financial literacy and the ability to talk finance is the language of healthcare, business rather, is the language of business. If you want to be a leader and you want to be both perceived as important in the organization, influential in the organization, you have to understand this stuff, and you have to get an understanding to the point where you can talk about it at a reasonably good level with those folks who make this their world every day. One of those folks is Richard. So Richard, we're going to start with these fundamental areas of healthcare finance and what we're going to really cover today. Do you want to kind of kick us off and take us down this list?
Thank you, Jerry. I'm happy to share with the audience what I want my compliance officer to know. I don't need a compliance officer that duplicates my role or my work. What I need is a compliance officer that understands my language, and we have a different language than everybody else. And so I've divided it into several big pieces. The first one is healthcare financial fundamentals, and this includes and incorporates the three basic financial statements. It includes revenue cycle management, and it includes the cost structure. The second area, regulatory and compliance, is really four pieces. It's CMS, or Medicare, Medicaid reimbursement, the 340B drug pricing program, the Stark Law anti-kickback statutes, charity care, and 501R financial assistance requirements. The third section, budgeting and capital planning, that incorporates what the compliance officer should know about the operating budget and the capital budget and the debt financing. Next, internal controls and risk. And of course, the compliance officer's very much aware of internal controls and risk But coming at it from a financial perspective, we're looking at segregation of duties. That's a big section. We're looking at what audit processes we are using and following. And of course, the third area is grant and research compliance. The number 5 here are KPIs, key performance indicators. There are lots of them, but there's several that are more important than I think than all the others. Number 6 here, this is the communication and collaboration between the CFO and the compliance officer. The CFO is busy. They're not looking for extra work, and they're not looking to go around and train all of the other executives in the organization. So when we get to this section, there's some things I think that the compliance officer needs to do to be proactive and develop their own skills. And then finally, there are some tools.
And the tools section, I'm gonna take over because there's a specific tool called an S-bar, and we'll cover that when we get to it. But all right, this is what we're gonna talk about. Let's go ahead and jump in with the 3 types of financial statements. Now, I have to say, Richard, when I first learned about these and I looked at them, they were frightening and they were intimidating. Can you take us through just the basic, what these 3 are?
It can be for a non-accountant, but the 3 statements, balance sheet, income statement, and statement of cash flows. The first 2 are accrual basis statements, and the third one is a cash basis statement. And already with that, I've scared some people, but let me say it like this. Accrual basis, we record revenue when it's earned, not when it's received. If we provide a patient service today and Blue Cross pays us 9 months later, we're recording the revenue in this month, today, because it was earned this month. With expenses, they're the same way. If we agree to pay for a service or a product, even if we haven't started using it, even if we haven't received it, when did we incur the expense? Under the accrual basis, we record when we accrue it, when we have decided to obligate ourselves for it. And the balance sheet is also on the accrual basis. The statement of cash flows is quite the opposite. When did the cash come in? When did the cash go out? So balance sheet, income statement, or accrual basis, statement of cash flows, or cash basis. Now the balance sheet is a photograph. It is what the organization looked like on that day. The day before is different. The day after it's different. What did it look like on that day? And it tells you 3 things. What do you own? Those are your assets. What do you owe? Those are your liabilities.
Richard, I'm sorry to interrupt, but we're going to go into each one of these. Do we want to save those kind of things for the next couple of slides when we actually get to balance sheets and income?
Sure, okay. Let's do it.
I'm sorry. So the main crux of this slide, I think this is the first thing that I learned that started to get me more comfortable, and you explained it so well. Accrual basis is when the service gets delivered, I record it. Cash basis is when the money comes in or the money goes out, I record it. That for me was eye-opening from those concepts. Let's dig in. You were walking down the balance sheet road and I interrupted you. Keep going.
No, that's good. The balance sheet at a point in time. This is a photograph. It's a snapshot. What you own are your assets. The most important one is highlighted here, that the most important asset is what cash do you have. Most of the hospitals that have closed because of cash, no other reason. And so this is the most important thing you're going to see on the balance sheet. What you own are assets. What you owe are liabilities. The difference is your equity. If this was your house and you bought a $300,000 house and you paid $50,000 down and have a mortgage of $250,000, your balance sheet, assuming that's your only asset, your balance sheet would have an asset for the house of $300,000. It would have a liability for the mortgage of $250,000, and your equity would be $50,000. If that was the only thing you owned, that would be your balance sheet. And so what we do with the balance sheet is we have everything you own in assets, everything you owe in liabilities. The difference is equity.
Okay, so these are the core concepts associated with this snapshot, with this balance sheet. Next, we're going to move to the income statement. And again, when I say the core concepts, for those of you folks on the phone, this is the stuff that you, Richard, please correct me if you think I'm wrong. These are the things you need to understand. And at a minimum, you need to be, well, let me ask you a question, Richard. How often should a compliance person, or regardless of whether they're compliance, somebody who wants to demonstrate leadership, somebody who wants to be more engaged within an organization and get a better understanding of the business of healthcare, how frequently should they look at this balance sheet?
I think the compliance officer should take the initiative and make a monthly recurring appointment for an hour every month with the CFO. And one of the things that would be covered in that hour would be the most recent set of financial statements, so that the compliance officer has a minimal understanding of the financial picture of the organization. They don't have to know it well enough to explain it to anybody else, but they need to know it well enough to know, are we improving, deteriorating, holding steady?
Okay. All right, and we'll spend more time on that when we get to that sixth element in our conversation today around communication. Let's now move to our income statement. And what are the highlights? What are the things that we want to absolutely be sure to key on?
So we've got total revenue highlighted, we have total expenses highlighted, and we have the difference between them highlighted for operating. Now we distinguish between operating items and non-operating items. And operating items are your regular course of business. Non-operating items, when you buy or sell real estate, when you buy or sell equipment, dispose of assets, when you refinance debt, these are not operating items. So we make a distinction on the income statement between everything that's operating and everything that's non-operating. And one other aspect of this slide is what you see in revenue does not mean the money has been received. People ask me sometimes, why is our revenue going up and our cash going down? And my answer is, we provide the service, we spend the money for the salaries and the supplies and equipment and everything, but we don't get paid till 9 months later. So it looks good on the income statement because we're earning revenue. But the other aspect is, when do you convert that revenue to cash?
Excellent. Richard, a quick question, and this is a little off script. I'm sure it won't throw you though. If I'm looking at this income statement, are there any conclusions that I can draw looking at from 22 to 23? What kind of, I mean, if I'm looking at this right now, these are kind of just numbers. What conclusions might I draw, let's say, from deficit of revenue over expenses? What conclusions can I draw from 22 to 23? Am I doing better? Am I doing worse? You know, what do you think?
Well, you jump to the bottom line and you look at 2023, you had a loss of 2,000. 2022, you had a loss of 69 plus. So the loss is smaller, so that's better. Now, an income statement can be for any time period. It can be 1 month, it can be a quarter, it can be a year. And usually we want to compare it, either current month versus previous month, current year versus previous year. The other thing to think about at the bottom line, there are a lot of hospitals that lose money every year. And so they don't pay income taxes. So what's the big deal? Can they keep going, paying, losing money every year? No, they can't, because when you lose money, everything on here that's an expense, except depreciation, is a cash expense. So if you're losing money, you're losing cash, and cash is the only way you're going to survive as an organization. So you have to look at the bottom line. The other thing is, if you want to build a new hospital, you're not going to be able to do that when you have years and years of losses, years and years of declining cash flow. It's going to be very difficult. You can still borrow the money, but you're going to pay a higher interest rate. Two people go into a used car dealership, buy the same car. One pays cash and one has good credit, one has bad credit. They're not paying the same interest rate to borrow that money. The person with bad credit is paying more, and that's what you're looking at on the bottom line. That's going to come back to be a factor someday.
Excellent. You mentioned cash flow. Let's go to our last of the big three financial documents. This is one I still have trouble with. So take us through.
So cash flow statement, the money that you deposited in your bank account, or multiple bank accounts, the money you deposited is your cash inflow. You have cash coming in and going out in three sections. You have operating activities, which is your main course of business. You have investing activities, and you have financing activities. Now, the operating activities, if you're a hospital, that's everything you're doing to maintain your services to your patients. From investing, that is when you buy and sell real estate, when you buy and sell equipment, dispose of equipment. It all has a consequence. And financing is generally when you borrow money or when you refinance money. Why do we segregate the statement of cash flows into three areas? Because we want to know where our cash is coming from. We need to support our organization by cash flow from operations. We cannot, for very long, sustain our organization with cash flow from investing and financing activities.
So if I'm looking at this document, I'm thinking, okay, correct me if I'm wrong, we have a challenge with operating activities. Cash associated with operating activities dropped pretty dramatically, but my net cash from investing was significantly better. As was my net cash used. Well, my net cash used in financing was not good because, or was it? I'm sorry. Did I use more cash here, or tell me about this?
Yeah, so you're looking at $8,000 in 23 for net cash provided by investing activities, and negative 68 from 22. And the biggest reason for that is your investments that go up and down. Most hospitals have investments to some extent. It's not part of operations, but you can have gains and losses on your investments. You can have gains and losses on real estate when you buy and sell real estate. The bottom line, though, is cash needs to go up. Cash must go up each month. It's a danger signal when it goes down. The other thing is your cash needs to come from operations, because you cannot sustain an organization for long term with cash from financing and investing activities.
Got it. All right. Let's move on to revenue cycle, and we're going to spend the lion's share of our time on this slide related to our reimbursement models. our presumption is most people have a pretty good understanding of how revenue cycle or what's involved in the revenue cycle.
Well, I think our compliance officers do have a basic idea of the revenue cycle, but whatever level of complexity you think exists in the revenue cycle, well, you can double that, because it's a lot more complicated than what most people realize. Now, all hospitals are in 4 camps or 4 groups: prospective payment systems, critical access hospitals, disproportionate share hospitals, and tribal hospitals. The Medicare rates are different, the Medicaid rates are different, and it has an impact on the revenue for your services. So as an example, a PPS hospital is not getting the same rate for an inpatient stay as the critical access hospital. There are differences among the 4 types. Revenue cycle is generally divided into 14 steps, but we've got the biggest ones here: scheduling, registration, coding, billing, and denials. I think our compliance officers on the call would be most familiar with the coding, because coding audits are sometimes involve, to some extent, the compliance officers. When it comes to the revenue cycle, there are maybe however many you're contracted with, those are in network. And however many insurance companies you're not contracted with, they're out of network. So that also makes a big difference. The healthcare business, as we all know, is very highly regulated. The revenue cycle is very highly regulated. How we code is regulated. How we bill is regulated. Even to the extent, in some situations, how we register patients. There are many regulations to comply with.
All right, let's move on to our the 4 key areas of regulatory and compliance from the healthcare financial fundamentals perspective. Richard, go ahead.
So number 1, everything starts with Medicare. They're the basis for all of the other payers. The Medicare, if there was a hospital in California a few months ago that lost their Medicare participation, and they closed soon after. So that's usually a very, very serious situation when that happens. The compliance with Medicare and compliance with Medicaid is not only for the revenue cycle folks, it also requires the chief financial officer and the chief compliance officer to have some knowledge and involvement with that. The second area, 340B, that's probably the most complex and most regulated area that we have at the hospital. And I've had compliance officers tell me that they don't know anything about 340B and they don't want to learn it. And that's for me and the pharmacy director. And my response is, no, it's not true. You're a compliance officer. That means you have a role for compliance in everything that we do, and that includes 340B. You don't have to be a 340B expert, but you do need to help us ensure that we're in compliance, not only with regulations, but even with our own policies and procedures. Stark and anti-kickback, I think our compliance officers are familiar with that, but I'll just say this, that you can't pay somebody more than you should pay them. You can't pay for a building more than you should pay. Everything's fair market value. And so this is where I think the CFO and the compliance officer can collaborate to ensure that we are in good stead there. Charity care and 501R, you might say, well, why do I care about that? Because my hospital is a not-for-profit. And I would just say, well, I spent 6 months with the IRS in my hospital learning that they do care about a not-for-profit and the financial assistance requirements, everything that has to be posted, what kind of language it has to be posted in, how you turn people on over to collections, bad debts policies. All of this is of interest to the Internal Revenue Service.
Okay. Sorry, I was taking a note on a question. Next, we're going to go to budgeting and capital planning.
So operating budget, it has to be approved by the board once a year. That's a legal requirement. It has to be provided to the state, whatever state you're in. And that is separate and distinct from the capital budget. Now, each organization has a different threshold, but in the hospital I'm at now, we have to go to the board of directors when you spend $10,000 or more for a capital item. So the operating budgets and the capital budgets are both required. They have to be done before the end of each fiscal year or calendar year, depending on the case. And then the third area is debt and financing. Now, in most hospitals, at least not-for-profit hospitals, you're not going to have very many transactions in terms of your long-term debt from year to year. You may have a bond series that goes for 10 or 20 years, but not too many new things. The reason I mention that, though, is, and this is something that the compliance officer should know or be aware of, is that every long-term debt, every bond series has debt service coverage requirements, which means you have to measure those and compare with what you've signed to agree to. If you say I've agreed to maintain 1.25 times my debt service, and you're not doing that, then you're not in compliance.
So the concept of debt and financing is, I mean, which, I'm just curious, this is really a question from my perspective, not necessarily our audience. When I look at these capital budgets and operating budgets, I understand debt and financing, that's a moving target often. And I'm guessing the CFO really keys on that on a pretty much ongoing basis. Is that true?
Yes, it's part of the CFO's world. For example, you have to invest in new equipment. You have to upgrade your equipment. You can't sustain your operations, your patient services without it. The question is, how are you going to pay for it? Of course, if you have the cash and you pay cash, then you don't have to pay any interest. How many organizations are able to do that? More than likely, you're going to have to finance or lease that equipment and hope that you generate enough revenue ultimately from that MRI or that CT scan that you can pay for the debt service and have something left over.
Yeah, so that in terms of operating the business and within healthcare, that becomes absolutely crucial. Really interesting stuff. Let's move to internal controls and risk management.
So the compliance officers, they're certainly familiar with segregation of duties, but I'll just give you one example. Is the person who collects the patient payments, co-pays up front and creates a deposit slip, that is not the person who takes it to the bank. That's an example of segregation of duties, so that you always have two or more people. In order to cheat the system, you'd have to have collusion. That's the basic idea. And the segregation of duties is not only collecting money, it's approving invoices. It is approving travel to conferences. Everybody has to have somebody else approving their transaction. So segregation of duties can apply in many situations. Audit processes, we have so many audits. We have external financial audits, 340B audits, coding audits. We have internal audits of various processes. So the compliance officer does not have to be an expert in the financial audits, but they do need to know what the general ideas are, the general concepts, and there are internal control procedures that have to be certified in every audit. Finally, grant and research compliance. If you receive money, you have some reporting requirements. You have issues regarding how you can spend the money, what you can buy, when you can buy it. And also, if your organization has $750,000 a year or more in grants, total grants, then that triggers the single audit, which is in addition to the external financial audit.
All right, now we're going to move to something that I'm going to admit, as we built this deck and as we went through this, I found this difficult to understand. Let me kick off this slide with one concept. The KPIs, the key performance indicators that we have here, these aren't necessarily, the ones that everyone should be, involved in. We don't want to state that these are the ones, but in Richard's years of experience, he found these to be very important. If you want to learn more about these, because to go into these in depth would be a little challenging, especially that last one, payer mix on the right. If you want to learn more about these, feel free to Google them. But we are now going to go through some of these key performance indicators, talking about just briefly what they are and why they're important to the organization. Richard, why don't you start us off with operating margin?
Yeah, so you don't have to know how to calculate these. Your CFO will calculate these, but you should know what they mean. An operating margin means how much of your revenue that came in translated to the bottom line. If you've got a 2% operating margin, then that means that 98% of your revenue either went to deductions from revenue and or operating expenses, and all you got left over is 2%. It's like, the two congressmen, they left Congress and went into the fruit business, and they bought watermelons for $1 and they sold them for $1. And the first congressman said, well, how come this business not working out as well as I thought it would? And the second congressman said, well, I guess we're going to have to get a bigger truck. So the point is, your operating margin, you don't have to know how to calculate it, but you got to have one that's positive, and it should be getting better. That's what you have to know. The days cash on hand, that's the most important KPI that I could describe. And that is, how long can your operation sustain itself with the cash that it has if money stopped coming in? You've all heard about the government shutdown. Well, guess what? Our cash flow is going to be severely hampered from now to December. And so how long can your organization go without any money coming in? How many days can it pay the salaries, buy the supplies, and provide the expenses? The days cash on hand, that needs to be going up. If it's going down and it continues to go down month after month, that's a big red flag, and we all should be taking note of that. Days in accounts receivable. If I provide a service today and my average days in AR is 67, that means it takes me 67 days to convert the revenue that I earned into cash money. We don't want that number to be going up. We want that number to be going down. We want to get our money faster. The clean claim rate. How many claims did we bill correctly on the first pass? You think, well, why don't you do 100%? Well, that would be nice. Nobody does 100%, but the intricacies are too varied and too great to get 100%. But our goal is 85%, and we usually hit that. That means the first time we bill correctly. The denial rate. How many claims did you submit that were denied? A denied claim means you have to rework it. at least twice. That means you have to spend more resources to appeal the claim. So the denial rate is very important. Finally, the payer mix. What percentage of your business is Medicare? What percentage is Medicaid? What percentage are commercial plans? Why is that important? Think of Medicare as being break even. We don't make any money on Medicare. Once we get the cost report settlement on Medicare, we're balanced. So we didn't make a profit or loss. Medicaid is about 80% of Medicare, which means we lose money on every Medicaid encounter that we provide. We have to make it up with the commercial plans who are better than Medicare. So think of Medicare as break even, think of Medicaid as below break even, and commercial as being above break even.
All right, excellent. Again, these are key performance indicators. If you have a desire to learn more about them, you can certainly get on the internet and learn a little bit more about how they're tabulated and other information. Now we're going to talk about what I think might be maybe the most important aspect of our webinar, which is how do I work with this person who is in the big ivory tower? How do I work with my CFO? When many of us see a C in front of a title, I know I certainly do, it makes me a little nervous. I feel, you know, I may not be prepared or as prepared as I need to be. Richard, give us a little insight as to how do I work with someone like you?
So I do interim work. So I've worked with a lot of compliance officers, and I don't sit around and think, hey, I've got a free afternoon. I'm going to see if the compliance officer needs help, and I'm going to help them with their development. No, the CFO is busy. The CFO is always busy, and they're not looking for extra work. So my suggestion is that the compliance officer take the initiative. Don't wait for the CFO to come to you. You go to them and you say, Mr. CFO, Miss CFO, I want 1 hour with you every month. And here are the things that I'm going to be talking about. I want you to explain the financial statements to me. I want you to talk about the audits that we have going. And I want you to help me with the things that I want to know, that I want to understand about our business. This is on the compliance officer to make this happen.
Excellent. And keep in mind, audience, that maybe you don't. I mean, I don't want to basically say something different than what Richard said. Maybe you don't ask for an hour. Maybe you ask for half an hour. Whatever you think is right and what makes sense. But the key point is to engage. Is to don't be intimidated. Take the initiative, get in front of it, and come prepared with an agenda. We're now going to switch, and we're going to move a little bit away from Richard's part of the presentation, and I'm going to handle some of the next stuff, which is the tools. So there are a lot of different tools out there that are used in the financial world. And one of the tools that's used very, very effectively, by healthcare is known as an SBAR. An SBAR is a document that is used to generally justify a course of action. It's a tool that we're often asked to put together, which demonstrates a return on investment or a savings or a percentage of time saved, whatever it may be, related to someone using our product. But the SBAR and the SBAR tool can be used for lots of different things. Again, it's designed to provide a return on investment. SBAR is an acronym that stands for situation. What's the background? What's our situation? What's the background associated with our situation? What's the assessment we made? And what are we recommending? So we're going to start with the situation, and we're going to go through this pretty quickly. By the way, if anyone has any questions that they want to submit to Richard, do me a favor, begin. We're getting close to the top of the hour. If you don't mind, go ahead and throwing those in the chat. That would be terrific. But in this case, our situation is we're a health system, and I'm not going to read the whole text, and we're highly regulated. Richard alluded to the massive number of regulations that we're dealing with. And at the end here, due to the number of regulatory changes and what is stated above, managing these changes creates operational, financial, and reputational risk. So that's our current situation. From there, we'll go to background. And the background concept is really designed to demonstrate that when you're presenting this to your CFO or compliance committee or whoever it is that you're presenting it to try to get them to provide you with what you're asking for, they want to know that you did the work, that you went ahead and looked at this and really spent some time researching, thinking, and trying to figure out what's the best course of action. So the background of this one, in this particular instance with the SBARs that we do, basically revolves around the 7 elements of an effective compliance program. Our audience, our CFO, they may not know the 7 elements. So we mention the 7 elements and we talk about some of our challenges. We don't have the ability to ensure that we're getting all new regs. We don't have to determine what, if anything, is done to comply easily and simply. And this last statement again, this puts us at risk of not being able to correctly perform all but 2 of these required elements. So all but 2 of these required elements we're at risk of. That's our background. Next, we do an assessment. This is, for all intents and purposes, a business argument. This is what I'm going to do in terms of, or what I'm thinking about in terms of assessing where I am today. So to effectively assess the issue, I need to review 2 different concepts. Number 1, what's the cost of us complying with these regs today? Number 2, what are the risks and costs if we don't do this today? Next, I lay out a set of steps that need to be completed to do this work. Again, this is important. You may know this. You may know this in your sleep, but you want to make sure that the audience that you're providing this SBAR to understands that you've given this the proper amount of thought, effort, and energy to basically ensure that the ask was well thought through. Next is a financial assessment. You put together a chart which demonstrates the cost associated with what you're doing now and a potential savings. I'm sorry, this is the other part of the assessment. That's the back, this is the top part of the chart. This is the bottom part of the chart. And basically, again, this has got financial assumptions in it, things like employee salaries and hours taken to do things, and then annual cost. And then at the end of your assessment, based on this assessment, this is the information. Next comes your recommendation. You're now, based on the assessment, making a recommendation. And you want the recommendation to be well thought through. You want to institute a standardized process for regulatory change. You want to gain visibility to see what everyone's doing around the organization. You want to ensure that the activities are accurate. You are complying with the law accurately. You want to track them and you want to be able to demonstrate them. And then here are the 4 vendors that do this. These are if you decide you want to go with a third party, these are the vendors that do this. Whoops, sorry about that. And then over here on the right, you can see there's a long chart, and you would make a recommendation based on the assessment of these 4 vendors. I've gone ahead and wiped them out. We want to keep this biased. This is not a commercial. Again, the main goal of the SBAR is to demonstrate that you've gone through a thoughtful, business-oriented approach to why you're asking for this particular spend or purchase or whatever it is you're asking for. Richard, I'm going to put you on the spot. I didn't ask you this in our run-up to this, but when you see something like this from somebody versus if someone comes to you and says, I want to buy a thing, and here's what it costs, and here's the why. How do you view these two approaches? The SBAR approach, I would view highly more refined versus a less refined approach. What's your view as a CFO? I guess I just biased the heck out of that, didn't I?
Well, I can tell you that almost 85%, I would say, of the people who come to me that want to buy a service or buy equipment have not done this kind of analysis before they come to my office. And so when I start asking them questions, they say, well, I don't know, I'll find out. I do have a few, I've had a few that come prepared. And when you come with this kind of analysis, then that saves a lot of time, because there are things I don't have to ask and things I don't have to investigate. This is a great time saver.
In addition to being a time saver, and I'm putting words in your mouth, but feel free to disagree with me, would you view someone who does this to this degree, now they don't need to do it with smaller things, but something that's significant, do you view them as better prepared for leadership and potential leadership roles?
Well, one of the important aspects, I think you alluded to it by having 2 or more vendors in the analysis, is that I don't want you to bring me a recommendation for somebody that you've worked with them for years, you like them, you're comfortable with them, and you didn't look at any other vendors. That's not going to be acceptable to me. I'm glad you're friends with them, but this is business, and I need to know what are the choices, what are the other options. You can't just bring me one vendor and say, I want to use them. You got to show me, why is this vendor better than the others?
I did not include this, and I'm really glad you brought that up. I didn't include this in the recommendation only because if I included that last piece, which is where whoever this person is submitting the SBAR, they say, I want to select one vendor or another. If I would have put it in here, it obviously shades to us, and I did not want to do that. I did not want to provide additional bias. So yes, if someone's doing something like this, you're going to provide the 4 vendors, and then at the bottom of the recommendation, the compliance officer would say, based on my analysis and evaluation, here's what I would recommend and here's why. Richard, I'm going to ask you to give us the key takeaways. And again, if there are any questions, we did get one question, but if anyone else has any questions, feel free to put them in the chat now. Whoops, sorry about that. Richard, what are our key takeaways from this presentation?
We go back to the 6 items that we started with. The financial fundamentals, that includes the 3 basic financial statements, the revenue cycle, and the cost structure. We talked in the second group about regulatory and compliance connections. That's Medicare, Medicaid, 340B drug pricing, Stark Law, and anti-kickback, the charity care, and financial assistance. The third section, the operating budget, the capital budget, debt and financing. The fourth thing was internal control risks. We talked about segregation of duties, audit processes, grant and research compliance. Number 5 were the KPIs, and we had several that I thought were more valuable than others. And 6th is how the compliance officer can have better communication and better collaboration with the chief financial officer.
Excellent. And then the last 2, don't be afraid to ask questions and build partnerships. Don't get out from behind the computer. You know, this is something that we hear, and this is not an indictment of compliance per se, but almost every webinar that I do, and Caro, who helps us do these webinars within my organization, she will tell you I do too many. One of the things we universally hear is get out from behind your computer and go build partnerships. And you certainly want to do that with finance and compliance colleagues. Some additional helpful resources: the HFMA, Healthcare Financial Managers Association, your local state hospital the American College of Healthcare Executives, and then the Financial Intelligence for Healthcare Executives by Berman and Knight. Our next webinar will be November 4th at noon Central Time, which is around leading teams. Really important if you're going to be perceived as a leader, if you want to be perceived as a leader and begin to move up within your organization, the concept of demonstrating leadership for both compliance and quality will be the focus of our next session. We do have one question. Richard, the question is, do you have any recommendations for what to include on an agenda when you're visiting with the CFO?
Yes, I would start with the most recent financial statements presented to the board. You don't have to understand everything about it. You just need to take 2 or 3 takeaways from what's going on with the financial situation with your hospital. The compliance officer needs to be in touch with, are things improving? Are they deteriorating? Are they holding steady?
Excellent.
The other thing that I would,
I'm sorry.
yeah, the other thing I would say is, tell me about the external financial audit. Tell me about the coding audit. Tell me about the 340B audit. Tell me about the internal audit for this area. The compliance officer may not have been assigned a task in any of those audits, but the compliance officer should have some basic financial familiarity with what was uncovered, what are the issues, what are the major problems.
Terrific. All right, I believe that is it. We are done. Michelle, I will turn it over to you.
Well, thank you, gentlemen. As a reminder, you can type any questions using the chat or the question pane to the right of your screen. Please identify the name of your organization, so this gives the speaker insights to any considerations. I've got one question that was emailed. As a CFO, where do you see compliance struggle most when it comes to healthcare finance?
I'll give you an example. When I was a high school football official, and I would go into a stadium of thousands of people, the only friends I had there were the other striped shirts. The compliance officer sometimes feels isolated. People think they're the police, or they don't want to be friends with the compliance officer. But the compliance officer is a tremendous resource for the organization. We cannot do what we need to do if we're not following procedures. And calling somebody out on not following procedures, that doesn't mean that you're the police officer writing a ticket for speeding. It means you're helping the organization. You're saving us fines, penalties, and other negative results. The compliance officer is a positive, has a positive role to play in the organization. In order to do that, you can't stay in your office and hide. You have to be engaging. It doesn't mean that you're trying to find out things that they don't want to tell you. But you need to have a working relationship with at least the leadership of the organization, and certainly with department directors.
Michelle, any other questions?
No, sir, it doesn't look like it. So if you have any additional questions regarding today's topic, their information is there on the screen. And please feel free to email them or contact me if you need an introduction. Thank you so much, gentlemen, for your time today. We'll stay on the call until folks drop off.
Richard, thank you.
Jerry?
I appreciate your time and your effort here. It was terrific.
I'm glad to help.
Jerry, I'm looking forward to seeing you at the summit, sir.
Yes, I also am looking forward to my trip to San Antonio. It's going to be fun. I have a lot of travel this month, so I'm not going to be spending a lot of time coming in, and Rocky will be there manning our booth, and we're really excited. You know, the t-shirts and the socks that we give away, people love. You've seen it before, I think. I wasn't at the last one. You know, Rocky did the last one without me. I'm excited to do the session.
Yeah.
The session's going to be fun.
Great.
I'll do some giveaways there as well. Get the customer engaged, or not the audience, excuse me.
Yeah, that's a great idea. There's a lot of excitement around this year's conference. You know, last year we celebrated 25 years and that was really a hoot, but there's a lot going on this year, you know. So I think it'll be very informative. All right, gentlemen, it looks like that's about the last of them. I will connect with you. If you have any questions, feel free to holler.
All right. Thank you very much.
Thank you again, Richard.
Richard, thank you again for all your time, effort, and energy. This was terrific. And if you have any questions, let me know. And we will talk again soon.
Bye.
Bye-bye.